People who find themselves permanently and totally disabled frequently apply to get their Social Security benefits paid to them early as disability benefits. This process is usually very involved and often takes several years before approval is granted. Once benefits are granted, the initial payment can include a large lump sum covering several years and can result in a substantial tax bite. But this tax liability can be lessened or even eliminated using a special lump sum election for those back payments. I'm the Tax Geek, and here is the Social Security lump sum election oversimplified. To briefly recap, Social Security benefits can be taxable if one half of the benefits plus all your other income exceeds certain thresholds. For more detail on when Social Security can be taxable and how to calculate how much of your benefits are taxable, click the card above or check out the link in the video description. A lump sum election is pretty simple in theory. Let's say you received a lump sum of Social Security benefits in year C that contained benefits that were payable in years A and B. To calculate a lump sum election, you figure out what the taxable portion of the benefits would have been if they had been received separately in years A, B, and C instead of all in year C. If the total of the taxable amounts of the separately computed benefits is less than the taxable amount of the lump sum you received in year C, then you would benefit from a lump sum election. To calculate a potential lump sum election, you need to know three things for each of the current and prior years: the amount of Social Security benefits designated for each year, your adjusted gross income for each year, and your filing status for each year. Let's clarify how this works with an example. Edwin was diagnosed with renal failure in 2019, and since then he has had to receive twice-weekly dialysis treatment while he waits for a kidney transplant. As a result, he was no longer able to work and applied for Social Security disability benefits in October of 2020. After many months of considering his application, the Social Security Administration finally granted his benefits in February of 2022, retroactive to October 2020. Edwin is married to Linda. Linda was a homemaker before Edwin had to stop working in July of 2020. After that, she worked part-time in order to care for her husband in 2020 and 2021. In 2022, once Edwin started receiving his benefits, Linda found someone to care for Edwin and went to work full-time. Here is Edwin's SSA 1099 for 2022. He received a total of $49,575. This included $5,175 in benefits for 2020 and $21,900 in benefits for 2021. Here is Edwin and Linda's modified adjusted gross incomes for those 3 years. $24,600 for 2020, which consisted of Edwin's salary of $21,000 and Linda's earnings of $3,600. Linda's earnings of $7,200 for 2021 and Linda's earnings of $27,500 for 2022. If Edwin and Linda chose not to make a lump sum election, $13,044 of the $49,575 Edwin received in Social Security benefits in 2022 would be taxable. So let's see if a lump sum election would save them some taxable income. If they had claimed the $5,175 in 2020 benefits in 2020, none of the benefits would have been taxable. The same would have been true for the $21,900 in 2021 benefits if they had been reported on Edwin and Linda's 2021 tax return. If the 2022 benefits alone were reported in 2022, only $3,375 of the benefits would have been taxable. Taking the 3 years separately and adding them together results in $3,375 in taxable benefits, which is much lower than the $13,044 in taxable benefits had they not taken the lump sum election. If Edwin and Linda did not make the lump sum election, their tax liability would be $1,464 for 2022. Making the election would reduce their tax liability to just $598, resulting in a savings of $866. So how are all these calculations reported on Edwin and Linda's tax return? 3 or more worksheets are prepared to calculate the election. These worksheets are not sent with the tax return, but instead are kept with Edwin and Linda's records. Worksheet 1 calculates the taxable amount of the entire lump sum if it were claimed in 2022. Worksheet 2 calculates the taxable amount of the benefits allocated to one of the earlier years. One of these worksheets must be prepared for each prior year. In Edwin and Linda's case, 2 worksheets too, one each for 2020 and 2021, need to be prepared. And Worksheet 4 calculates the taxable amount of the benefits allocated to the current year, adds the taxable benefits from each prior year, and compares this total to the result from Worksheet 1. If the result of Worksheet 4 is lower than the result from Worksheet 1, then taking the lump sum election would be beneficial. It is not necessary to fill out these worksheets by hand. Computer software or a tax professional can take the necessary information, automatically compute the election, and if it would benefit you, enter the correct amount of taxable benefits on the tax return. It is important to note that even though a lump sum election involves earlier years, those earlier tax returns are not amended. Instead, the total from the lump sum election worksheets are entered on line 6B of the current year's return with the letters LSE beside them. As usual, I've skipped over a number of additional details relating to the lump sum election. For more information, you can check out the links in the video description. If you found this video informative, please give it a thumbs up and share it with anyone who would find it useful. Subscribing to the channel and tapping the bell alerts you to new Tax Geek videos as soon as they come out. And of course, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.